My name is David Basalski. I'm a IP, intellectual property and patent attorney and partner at Gearhart Law. We're the firm that kind of puts this on. We are all about education and empowerment, and so we put these on every month. Um, I'm gonna just jump right into it and introduce our speakers, but I'm gonna start with the one I've known the longest, which is Sean Broderick of SOSV. But he'll tell you more about who he is. And yeah, so Sean, maybe you can start and kind of introduce yourself. Take a few minutes to do that if you can.
Sure thing, David. Thanks so much for having me. This is fun. I hope I can be of help and service to the folks on this call. Very impressed with the turnout. I am Sean Broderick, as David already told you. I am a geeky venture capitalist. I am currently a venture partner with SOSV. SOSV is a about 1.5 billion assets under management early stage venture capital firm focused on human and planetary health in the deep tech space. And I am a general partner at DLab Ventures, which is a blockchain and Web3 earliest stage investor. I am an engineer by training, came up as a software guy back in the 80s and early 90s. Got bored of coding and thought that this internet thing might be something. Became an entrepreneur then. And then I have slowly transitioned into also being primarily now an investor, initially as an angel, and then running the first expansions of Techstars out of Boulder into Boston, Massachusetts, many years back, and then with SOSV as a general partner for many, many years, and now DLab, my current firm. So that's my quick story, and lovely to meet everybody. Thanks.
Awesome. Thank you, Sean. Thanks for doing this. We appreciate your time, and we'll definitely come back to you for sure. Let's go to our second speaker, Reese. Reese Williams.
Thank you. Thank you. Welcome from sunny South Florida. Say sunny, steamy, hot South Florida, sinking South Florida. Thank you for this opportunity, and it's just wonderful to see so many smiling, energetic faces from all over the globe. Really inspiring. We are a unique race into our own, entrepreneurs and investors. It's just wonderful to be among like-minded kindred souls. My background is pretty varied. I don't know if I'd call it a random walk or kind of a broad sweep, but I've kind of variously been an investor, an entrepreneur, and also a support professional to the entire space. On the investment side, my first kind of gig was with Gartner's affiliated fund called SI Ventures. Back in the dot-com era, we managed about 143 million in 3 funds. And it was really remarkable to kind of have a front row seat to kind of that wave of technology innovation and just watching the business environment, not only in the US, but globally be remade. Just really fascinating and historically significant for sure. And then thereafter co-founded New World Angels. We celebrated our 20th year recently. This is Florida's largest, oldest, and I would argue most successful structured angel group. And angel groups, if you're not familiar with them, entrepreneurs, you should, I would say, do your homework and study, learn as much as you can. They're difficult to understand. They can be mysterious in their structure and behavior, but they can be, in many cases, your only or your best source of capital. So worth the investment of time and energy to learn more about how individual angels work, but also how structured angel groups function. Thereafter, I co-founded a structured angel group out of a university. Florida Atlantic University is one of Florida's many public universities here. And that was also very interesting, furthering established the hypothesis that every angel group is unique and different, has its own personality, characteristics, and motivations. So again, pays to do your homework when you're looking for capital. On the entrepreneur side, I co-founded 3 life sciences companies, all spun out of public universities here in South Florida. I'm sorry, in the state of Florida, and have been involved as an entrepreneurial management at C-level for many years as well. One of the most interesting aspects of my opportunity to kind of work in the entrepreneur space and in the venture finance space was, if I learned a Germanic tongue as an investor, And if I learned a romantic tongue as an entrepreneur, when I ran an incubator for 5.5 years, I kind of learned Latin. And in terms of being able to bridge those various perspectives and languages and motivations, and it was really a remarkable period of time to kind of understand, kind of sit in the middle of those two different, very different worlds, and help build bridges, help kind of catalyze productive interaction between entrepreneurs and investors. So I just feel incredibly blessed to have had all those experiences, and I'm thrilled at this opportunity to share what little might be relevant to everyone's personal situation. So thank you, David.
Reese, thank you so much. Appreciate that. Really, thank you so much for the introduction. And last but certainly not least, Stu Strum Wester, maybe talk a little bit about who you are and your experience.
Yeah, thanks, Dave. Folks, my name's Stu Strum Wester. I run a firm called Green Circle Capital. We're actually a merchant bank, which is a term that most folks have heard and don't really know what that means. I'm not sure that I do either, but for us, it means that we have two divisions of our business. One is we play investment banker, and I also run a venture capital fund that invests as principal investor in deep technology. Everything that we do, though, is related to the food industry. My background, well, actually, before I tell you about my background, I just want to make a quick comment. I've been pissed and stressed about a million things all week long. And I got on this call at 11:30 and I was dealing with like 50 emails while I listened to some of you introduce yourselves. And all of that shit went away. And I just remembered how exciting and cool it is to be part of an entrepreneur ecosystem. I see Sean Broderick shaking his head. That guy's like a legend. But I listened to some of your quick little pitches, and I've started a couple of companies of my own. I'm thrilled to be here with you, and this is fun. I'll tell you a little bit about me real quick. My interest in the food industry and our specialization, thereof began when I was a kid. I became a vegetarian when I was 14 years old. I'm 58 today. So it was a long time ago. But I became an investment professional in 1990, and I worked for 15 years at big Wall Street firms. I started at Payne Weber, what's now UBS. At Oppenheimer, I worked, and I didn't have fun there, but I was making money. So it took me a while to get up the courage to quit and to try to do what many of you are trying to do or doing successfully right now. And I quit in 2005, and I launched a natural soda company, which I ran as CEO for 6 years. When I left there, I started Green Circle. We were originally focused just on the banking side. We got some traction, some credibility, and it kind of evolved into what we do today. So if it's a brand, that you might see on the shelves at Whole Foods, we continue to play banker. We sell companies and we raise growth capital for companies in that space, solely in the natural products world, food, beverage, supplements, personal care, only if it's natural, better for you, organic, plant-based. And the fund that I run, which we launched a little less than 3 years ago, invests solely in deep technology that is related to the production or distribution of food. Everything we do is mission driven and related to trying to protect climate, save the environment, animal welfare, human health. Our anchor investor is Hormel Foods. So even though it's a small fund, because we've got a big brother, we kind of punch above our weight class a little bit. And I frequently, get to interact with and coach, startups, and happy to try to help out in any way I can today. I just want to say one quick last thing. I thought it was very cool to hear from the guy from Broken Social Scene. I know your band. You're in a great band. And I was in a rock band in a previous life. And it's funny, this is a perfect segue because I always say to entrepreneurs, look, it's hard. You go through all this pain, but you're trying to do the second coolest thing in the world, right? First coolest thing is become a rock star. But if you can't pull that off, getting a startup off the ground is like pretty exciting and cool. So I'm pleased to be here with all of you, and really pleased that grateful that David invited me to join.
Awesome. Thank you, Stu. Thanks so much. We'll come back to all of you. Let's go to the legend. I agree. Sean is definitely the legend on the call. Stu kind of talked a little bit about, the types of investments he makes. Maybe you can talk a little about like your thesis. Like that's always a thing. Like what are you looking for? Like if you can sum it up maybe in a few words or sentences or something.
Sure.
What are
Let me tell you about DLab's thesis,
yeah.
um, and but let me also talk about thesis a little bit abstractly because I think it's an important point that people that are seeking investment money need to understand. Um, DLab is an earliest stage Web3 investor. We seek out the geekiest founders building picks and shovels in the world of Web3. We fundamentally believe that the nature of data ownership and computing ownership is going to change, and the technology of blockchain will enable that so that each of us individually will receive the vast majority of, say, the billions of dollars a year that Facebook is getting by leveraging our data and leveraging our time online. We'll actually be able to collect that data as people. And that's only enabled by a radically different economic structure that's enabled by blockchain technology. So that's one example of what it can do. And so our thesis is that this will be just as radical of a shift as the internet was. And I was lucky enough to be building products during the internet and investing during the 90s and aughts. And I see all the same patterns today as we go from, say, 2015 to now and beyond in the world of Web3. And so that's where we're looking at the world in terms of the abstract meta issue of these things. You want to understand what um, what investors are really looking at when you talk to them. A lot of people just hit out at 50 investors, and it turns out that 80% of them don't care about you. Like it just isn't part of their thesis. They don't know. Really good investors will tell you right up front on their web pages what they do, and nothing flips the bozo bit, if you will, than somebody who's building Web3 music systems and they start pitching Stu at a food tech, or a CPG investment group. It just doesn't make any sense. And so research matters, and start with a thesis and then work your way down.
Yeah, thanks, Sean. I agree. We get that question all the time. Oh, do you know any investors? But it's not about knowing the investor. It's about seeing if there's a match. That's really the key here. Stu, since you're off mute, you kind of talked a little bit about your thesis and kind of but maybe you can kind of go back over it from that angle.
Yeah, and I building off what Sean said, really great point, right? Understanding a little bit about who you're reaching out to and pitching is a good idea. Um, I always think of myself as a sales guy first. I've been, mostly selling investments for 34 years, but I think of things through a sales, kind of lens. So I'm all for, having a broad outreach and a big top of funnel. But yeah, it's pointless to reach out to tech investors if you're selling a food product or vice versa. And as you start to have conversations, as Sean said, do some research, and you should know who you're talking to. For my firm, on the buy side, we invest, as I said, in deep technology that disrupts or improves the way that we make food. And so that doesn't mean, to me, Beyond Meat, that's not like technology. That's just a veggie burger with a lot of ingredients. But I'm talking about things like fermentation and biomanufacturing is a big interest to us. There's a variety of subsets of that world. We're interested in things like we're interested in some segments of what some would call food tech that are kind of boring and uninteresting to others. What's exciting to me is not headlines, it's profits, and also the ability to help save the world. That those little goals are kind of what we focus on. So we're really interested in things like food safety, um, supply chain and logistics, Right now, like a big kind of fundamental theme for us is reduction of food waste, because we've got 1 billion people, that are food insecure on this planet, while we throw out about a third of what we grow. And that's just crazy. And when we throw it out, it rots and emits greenhouse gases, causing a double, hit to the environment. So we're really interested in technologies that might mitigate food waste or create efficiencies there in that regard, because I think there's huge economic opportunity as well as huge social opportunity. One thing I would say before I shut up is, I think I'm rambling a little bit, about our thesis. It's also really important for startups, for folks seeking capital, to understand what sort of traction, proof of concept, stage of development investors look for, because we're all really different. I mentioned on the prep call with this group, it was kind of cool for the audience that Reese, Sean, and I were all going to be available, because we all kind of are early stage investors, but very different, like sort of, stripes within that band. For us, we look for what I kind of call the like venture sweet spot, where there is real proof of concept and commercial traction, but it's early enough and it hasn't yet scaled, so that the valuation and the check size required isn't too big for us as a small fund. So we don't invest in concept stage businesses if it's an idea on a blackboard, and a company with 50 or 100 million in sales is way, way beyond our, ability to, make an impact, or for our check to be worthwhile to them. But to folks that have, disruptive technologies and are starting to get their first couple of customers, we look for third-party validation, either from blue chip partners who are doing pilots with them, or the first few initial customers. Because to me, we go by not what people say, but what they do. And what they do with their money is the biggest indication of their belief, right? So when I see a couple of big food companies have spent they've done a paid pilot, with a startup, that tells me, well, it was worth their time. Even though it's a small check, 3 or 4 people had to sign off on this, that it was worth it to give them 10, 20 grand. Even though these guys don't have millions in revenue, there's been some validation of the technology that interests me. I should probably stop there.
No, that's great. Thank you for sharing that. You brought up some good points. Let's go to Reese. So Reese, as the self-proclaimed angel of the group, how does your thesis stack up?
Well, we'd like to consider at New World Angels, and I'm going to hit enter now on the chat.
You pressed mute by accident.
Yeah, because we're all about technology here. I just hit enter in the chat to our website, New World Angels. We consider ourselves technology agnostic, but that said, we kind of try to put everybody in 4 different bread baskets, one of 4, and that is consumer products, life sciences / healthcare, industrial products / deep tech, and IT, which could either be software or hardware. And we recognize that often your particular company, product, or technology might blur, in between more than one of those categories. In that case, our due diligence teams will kind of converge in order to kind of work together to share their knowledge bases, to help figure out whether there's a good fit between what we're looking for our investment thesis and the company that you're building. In terms of what we look at, a couple of things. We look for, obviously, market's really important. Are you part of a large market that can accommodate many entrants? Does it have a very rapid growth rate, or is it just a smaller niche market, but one that you can dominate in relatively short time? We firmly believe that most large markets settle out into one dominant player, and also around a second, kind of like an Avis, and then everyone else is just kind of wannabes that either get acquired or ultimately kind of peter off or become lifestyle companies. So we look to see whether there's an opportunity, just from a market basis, whether you fit into that one of those 2 interesting categories. Secondly, obviously look at the team, and think of there's market risk, but then there's also management risk or execution risk. And so in terms of what you seek to accomplish, as you mentioned in your slides, do you have the human capital accessible to you, whether they're full-time employees or consultants or board members or advisors, or how, and how do you are you compensating them? Have you been thoughtful in how you kind of have them incented, not just to have their face on your deck, but are they actually doing real work? If we call them, will they really understand what you're doing? How often are you a good communicator? Are you getting maximum value for your relationship with them? That team, the concept of team for entrepreneurs is it's an evolving one, particularly in our current age of the way we now work and communicate, and kind of as an extensible team. And so your capacity as managers and as entrepreneurs to maximize that, to really find the knowledge, not only the knowledge, but the relationships and the database of relationships that every one of your team members has. We kind of really probe on that to see, because really that speaks to problem solving and also to resource uh, uh, accumulation, because solving problems that you inevitably will have to solve boils down to that. So how complete is your team, and how do you think about team, and how do you manage that team? What else? And then of course the product technology. We look to most of you may be familiar with the lean startup methodology and I-Core, which is kind of the federal government's adaptation of that. That's really, really important. That's kind of a gospel for us. That have you done your basic market research, and do you really understand, or what are you building products that people want and need, and how much do they want and need it, and then are they willing to pay for it? And then once you've identified that problem, does your design of your technology or product actually have the features that deliver the benefits that fit that screaming need? And I was encouraged earlier during the review, the networking stage, to hear somebody talking about doing their customer discovery work. So if you're not familiar with lean startup, you should definitely, there's some really good modules online that are free, and get familiar with that, because that understanding of your customer's problems, and then how your product or technology addresses that need is really key. And then what's the really nice cherry on the top is defensibility, and this hopefully will be music to David's ears. But we love intellectual property. I mean, my goodness, it's kind of like, oh, it's like, okay, you can fall in love with the technology. You can, be like, this is great. We've been wanting to make an investment in this particular space. We haven't found the right deal. And then, oh my gosh, there's also like something that can be protected here. Hopefully it's a patent, but if it can't be a patent, that's okay. By the way, Coca-Cola, its patents ran out decades ago, but it has trademark that is just incredibly valuable. And because for a number of reasons, not only do they have their products, but they've been able to extend their brand through trademark onto not just food and beverage, but also onto clothing and to other realms. And so we just believe IP is something that, because it is difficult for many entrepreneurs to kind of get their heads around, and also because they feel they can't afford it, they kind of neglect it. But that's a huge mistake. There are most IP attorneys that I've had the privilege of working with are very generous with their time and willing to point you in the directions where you can self-educate. But ultimately, you find a way to make IP and that defensibility and building a moat around your product part of your execution plan, because it points to, and I'm rambling now, so I'll just add one other thing. There's a couple other, but I think I've hit enough. But I do want to say, some of the more successful entrepreneurs and the business plans we look at give serious study to their exit strategy. And that is to say, they have a vision. They can say, you know what, we're developing this technology, we're going to turn it into a product, and that product will be a successful business. And that business is going to fit a key hole in the existing portfolio of this company or that company or this giant, this behemoth. They don't have a solution. We're building it, and we're going to have an auction for our services. By the time we develop what we're doing, by the time we get some revenue traction, by the time we've protected the IP around what we're doing, there's going to be several buyers. That's my dog, not my stomach. I apologize. There's going to be several buyers eager for what we have, and we're planning for that auction a couple of years out. And so one of the key drivers of valuation, exit value, very frequently is IP. So do your homework, learn about it, and make it a key part of your business plan.
Well, yes, I could not have said it better myself as an IP attorney, but thank you. But I want the take of everybody here. So Sean, what's your take on on intellectual property to SOSV to DLab. I think it might differ a little bit. Your personal take?
Yeah, so I've done many startups of my own over the years, back when, and we always were active trying to figure out uh, where we could patent something, and I've got a few patents issued and so on. Um, and those were generally valuable, almost always, in terms of exit maths. Um, I'm currently the DLab stuff today is a lot of things that go on in crypto are open sourced, so it creates very different environments, and it's okay because they're building these entities in crypto are generally building communities first, economies second, and products third, if that makes any sense. It's a different world than what we're used to, where somebody like Google owns everything and becomes a behemoth, if that's the right way to pronounce that. For SOSV, for sure, a lot of life sciences work there with a lot of patent work and other IP protections. The same thing with the hardware. So we do a ton of hardware investing at Hacks globally, and have extensive patent portfolios in the portfolio. Excuse me. And so definitely a helpful thing. Definitely a little weird in the world of crypto, but certainly in the traditional world, it's really valuable and worth the research.
Sorry, Stu. Thanks, John. Stu, what do you think? Your take on patents, trademarks, copyrights, even trade secrets?
Yeah, I have a few things to add here, and I think a little bit different too. It's funny because I'm a technology investor, even though I think of myself as kind of like a food and bev guy. Um, but we won't look at anything, we won't consider anything for investment where we don't believe that there's novel and defensible technology. Um, Now the question then becomes, in the real world, from a business application perspective, um, you know, how do you go about building that moat in a way that is practical or practicable? Um, I always like to say, and David may not love this comment, a patent is only worth, you know, as much as your ability to defend it in seven-figure litigation against much, much bigger, competitors. So when a startup tells me they have a patent, they're all set, that may or may not be the case. Um, my partner actually is a former patent attorney. So we do put great stock in patents and in the value of patents, but we also are believers in building, value and a moat around that value that is not limited to patents. We actually, for smaller companies that are not yet extremely well capitalized, I tend to think that a belt and suspenders kind of approach of utilizing both trade secrets and patents where applicable makes the greatest sense, because then you've got something that's been papered that you could take to a court if you had to. But if somebody with real deep pockets comes along and wants to pick a fight with you, they may not know everything, because once you patent something, you're putting it out in the public domain. Um, I'll stop there, but I'll just summarize by saying, going back to my initial comment, but we will only invest in businesses that are in some way tech enabled and built on, where one of the pillars of value creation is novel, unique, proprietary, and defensible technology.
Yeah, Stu, I agree with everything you just said. Straight up, I think the biggest thing I hear that I always try to kind of correct is when a startup says, "I have one patent." I'm like ready for investment. From my perspective, if you have one, it's easy to get up. Over it, under it, left of it, right of it. So, having, a kind of portfolio of not just patents, but trademarks and copyrights and all sorts of different things is probably the best way to go. But it does sound like from all of you that there is that is part of the consideration when you're looking at an
David,
investment.
let me
Yeah,
just
please,
add one thing. And
please.
when in talking about IP, I would also add that for me, coming up as a consumer guy, I also always like to say, at the end of the day, the only real barrier to entry is brand. And that is, apropos to like using Reese's Coca-Cola example. It's my understanding that there was no patent on the original Coke formula. It's a trade secret that they allegedly locked in a safe. I mean, frankly, I made a cola, right? If you gave me a good flavor chemist and we started at 9 a.m., by the end of the day, we'd have Coke. Like, it's actually not that big a deal. But what Coke has that is unbelievable, right? For a product that's essentially unhealthy and for carbonated soft drinks, which have been in decline just a tiny bit every year, year after year, for the last like 15 years in a row, it's the brand, right? That even today, with all this pressure on soda being unhealthy, that's like one of the top 10 or 20 most valuable brands on the planet, right? So again, the IP has to be part of a more comprehensive, overarching and long-term strategy for value creation, right? Because a patent is a critical component of your IP strategy, and the IP strategy is a component of building your business in a way that, once you have relationships with your customers, whether somebody else can do something similar becomes less important, right? If you have a brand, and there are customers that believe that you're a reliable and trustworthy, supplier, that starts to become way more valuable than those patents. But in the beginning, how do you, create and protect something? It's through your legal IP strategy where patents are part of it, I think.
Yeah, I agree with you. I often say that you kind of live and die by your brand. The trademark is the only form of intellectual property that could be renewed and renewed and renewed and renewed. Your patent's going to expire in 20 years. And so, you got to think, you have to kind of think about all that strategy. We threw around the word a lot, valuation. I think we need to talk about it for sure. And Stu, we can start with you since you're going to be on Spotlight. Um, what's going on with valuation? Like, I think nobody know. Like, what is it? Monopoly money? Like, how is a startup to come up with these numbers? Can you talk a little? Just maybe give some insight into valuation and mostly how important it is to have a valuation that will be communicated to you as the investor. So how do you view it as like, what are you kidding me with this valuation? Or like, how do you get to the right frame of mind of Stu with the proper valuation?
The right frame of mind is Stu. I would say with psychedelics. The Dave, there's like 14 questions to
I
unpack
know. Sorry, it's all
in
about
what you
valuation.
okay, so this is a topic that I hate talking about and that entrepreneurs are obsessively,
Maybe
committed
too
to.
much. Maybe too much about it.
Too much, yeah. And so that's exactly the point I'm going to make. Like, I'll begin by saying something that's probably going to be provocative. It doesn't actually matter all that much. And this is very hard for a lot of entrepreneurs, founders, CEOs to accept. Most of you just aren't going to believe me, but you might be interested to sit down and do the math, because, if you own, if you have one partner and you've raised a little money and you've had a little dilution, you own 35% of a startup, whether your valuation is X or double that, you'd be shocked how little it actually means to your actual ownership. And I urge people to actually do the math. If you're trying to raise $5 million on top of a 10 million pre-money, or $5 million on top of a $20 million pre-money, that's 100% difference in valuation. You'd be shocked how little it actually matters to that founder who owns 1/3 of the company today. It's a few percent, so first big advice, first, second, and third, stop fucking obsessing about valuation And two things that are way more important: get the money, right? Because 99% of startups that go out of business, that occurs when they run out of cash. And second of all, it's so important to get a good partner. Like, you got an example here, like Sean Broderick has been through like 9 billion startups. The advice and the value of that experience, having a guy like that in the room, no disrespect to Reese, I don't know him all that well, in your boardroom, to be able to pick up the phone and call him, like a couple of percent either way in valuation doesn't mean anything compared to the value of getting into business with the right partner. Not only somebody who could help you, but also get to know them a little bit and then decide, is this somebody that I'm going to dread getting a phone call from? Or is this somebody that I'm going to wake up every Monday going, I can't wait to get to that Monday morning call. I love this dude and he's helped me so much, you know? So, I'm not sure what, there were like 12 other questions. Valuation has come down. it's come down a ton. Like, okay, that's fine. At the end of the day, if you're the founder or CEO of an early stage company, you're going to get diluted along the way. If you're successful, you'll become really wealthy. If you're not, it goes to zero, it doesn't matter. Like, it is just not the key determining factor in what's going to happen in your life.
Thanks, Stu. I appreciate the honesty. Sean, what do you think on this topic? And yes, we'll just shorten the question. What are your thoughts about valuation?
Yeah, which definitely constrains it. Um, yeah, so totally on board with everything Stu said. People do obsess about this. The what you want to do at the beginning of your journey is understand how much money you might need and in what chunks you're going to get it. It's not a linear exercise. You're going to start out with a small amount of money. Then you're going to raise a little bit more. Then you might raise a bunch more. Then you might raise a huge round, or you might raise a small one. And every time that happens, the rule of thumb is that the investors will expect about 20% of your company. Um, and so if you just work from that as a rule of thumb, not a rule, but a rule of thumb, after day one, you're going to own 60% because it'll be 20% to the investors and 20% to your option pool for all the people you're going to hire with this $1 million you just raised. And then the next round will be, 20%. And then the next time you'll sell 20%. But to Stu's points, those things stack so that it's not like you're giving up half of your company every time. And so, valuation, the other thing that I would say is that there are industry cycles. And just as there are industry cycles and economic cycles, there are valuation cycles. Investors that stick around for the long haul, and I've been investing since the late 1990s. SOSV's been investing since the early 1990s. We've been through lots of cycles, and frankly, I don't change my valuation expectations. I simply don't invest when the valuations are too high, because one of the dangers to the entrepreneur, not to the investor, of raising at too high of a valuation is that cycles happen. And the next time you come around, it's way, way more painful to do a down round because those prior investors got all sorts of protections. And so you've got to be thoughtful about what a reasonable valuation is. And you've got to be thoughtful about trying to predict where your revenues will be and what the multiple is in your industry to get to that valuation number given that revenue. Valuations don't go in a straight line. It's a rise and a run and a rise and a run. And you need to think about what the steps are, the big steps that your business is going to have to go through, and what that 20% might mean. Again, rule of thumb at each of those steps. And so that's what I have to say about valuation. It's very complicated, it's very market driven, and you want to be thoughtful about what you're doing, very thoughtful.
Great, Reese. Any? I'm sure you have thoughts on this topic. Please share.
Oh, yes. Thank you for allowing me to bat cleanup after two world experts on this topic. Fine. I'm going to do my best not to be redundant and just kind of cherry pick and kind of, I don't know what you call it, just embellish a little bit on what's already been said. what Sean just mentioned, we refer to as the capitalization plan, the cap plan, and as investors, we want to know that you have kind of, I mean, ideally that you have done your homework on that. How much capital do you need to anticipated exit? And the best entrepreneurs say, you know, we're raising 3 million in a current or our seed round or our Series A, and then we believe that that will give us a runway. So we look at TBM, right? Timeline, budget, milestone. TBM, live it, breathe it, remember it. Timeline, budget, milestone. That's what the cap plan is. How much money do you need to run for 18 to 24 months? Because raising capital is a full-time job. And so by the time you close that round, you're going to have about 6 months where you can just focus on your business, and then you're going to start raising money again. So, and by the way, CEOs, 85% of your time spent raising money, 10% of your time is spent dealing with piddly, annoying, stupid ass HR annoyances, and 5% of your time is spent running the business, which is why you need an amazing team, a great COO and stuff like that, because you are the face, and you know your job is to raise money. Frankly, sales, as Stu said earlier, it is all about that. Now, I'm overstating the case, but just know you're constantly going to be raising money, and even when you're not, you're going to be telling everybody when you're going to be raising money next, right? All right, so back on the cap plan, timeline, 18 to 24 months, budget, how much money we need to get there, and get there, what does get there mean? What meaningful milestones are going to lead to a significant step up in valuation after the 18, 24 months? Basically, you're showing your investors, I am going to be a great steward of your capital. You're going to give me a million, let's just say. And in 18 to 24 months, I'm going to knock off these meaningful milestones: complete product development, first repeat sale, complete team, extend into, say, second, third market, whatever it might be for your particular industry and your business. And when I do that, we're going to step up the valuation. The post money last round is going to be up 2 to 3 times. Again, rule of thumb, Sean talked before about like 20% ownership. Usually you give up. Rule of thumb, step up can be 2 to 3 times generally. Flat round, I mean, that means there was an execution issue or the market interfered or something like that. Investors don't like that because that means they invested, you put their capital at risk for 18, 24 months, and then the next investor group gets the same deal. That's, you know, we really didn't get any value for our money there for taking all the risk. So what else? Cap plan, talked about the step up in valuation. It's not uncommon for companies that knock it out of the park to have that step up as high as 5 times. We've seen that. It's a nice place to be, 5 times past the post money, but it's tough to accomplish. But below 2, something happened there, right? You maybe should have configured your cap plan differently, or you should have any number of things, but definitely do the post-mortem on that. What else? Okay. What do investors look? How do we think about valuation? You know, we kind of do it 3 ways, really. Really technically 4. First is we love databases, right? If we can get access to them, a pitch book and the others, and if you are not already jumped into the arms of an awesome attorney for corporate law and for IP law and an awesome accountant who can help you get access to these databases free of charge, you should try to find one, because it's great to know the comps, because that should also be part of your deck, right? Okay, your deck's going to show comparables with regard to exits, recent exits in your space. You're telling the investors, look, you're not taking that much risk because other investors have done the same thing, and look, they're successful. The companies were acquired at this multiple, et cetera, at this takeout value. You're also going to show comps in terms of recent funding rounds. You can say, look, recently Amazon Ventures did a $10 million round in this space. So, you know, they must know something. So you don't want to get left behind. Don't miss out on this. So there's 2 different comps you're going to show. So the databases can show you the valuation, the amount of the capital, et cetera. The second thing we do is we kind of, just for laughs and giggles, we'll look at your discounted cash flow analysis, kind of your revenue projections, and say, okay, when you discount that back to present value, including the terminal value, what's the value today? Really, it's just a notional exercise. You can probably find someone to do that for you, but it's useful to see that you kind of have the ability to do financial planning, but really your business plan is obsolete the moment you kind of step out the door. So we don't put a lot of stock in revenue projections. But we want to see that, you know, what do they say? Business planning is everything. The business plan itself, not so much. That's some famous general said that. But that's the second thing. So databases, just kind of cash flow. Then the most important thing is our own personal regional comps. I mean, we go to conferences, we have lunch with fellow investors, we pick up the phone and talk, or do Zoom. So, you know, say, hey, we got this really interesting team. They're a little light on their regulatory knowledge, but They definitely have great IP, and there's a screaming need among pharma for this. And but they're early. They're easily 5 years from exit. They're probably going to need about 20 million to exit. So what are you kind of thinking about that? I'll talk with my friends about that. What are you kind of placing the value on that? And we'll just kind of talk. So there's kind of 3 points, and we put our finger in the wind, and we try to get the best deal we can, because angels, dirty little secret, angels lose lots of money. We lose so much money. I mean, 60% of our deals are worthless in 5 years, maybe sooner. So we need to get a good valuation. It's important to us, because those winners, when your company hits 10 to 20, maybe 30 times X, your victory for us and yourselves, all your stakeholders, is going to make up for all the sins in the rest of our portfolio. All those losing bets that we made, you're going to make up for it. And that's what makes it worth it. So that's why a low valuation is important for us. Last thing I'll like to share is that valuation is an important signal to an investor. How many of you try to sell your home before, and you know what your home's worth, and you think it's worth a lot more than the buyers think, and you sit and you wait a couple months, you really aren't getting to buy the interest in the market that you'd hoped for, and you start blaming your realtor. But really, it's about the price. The price is a really important signal, and the moment you lower the price a little bit, wow, miracle! All of a sudden, there's more buyers, etc. Well, for investors, I guarantee, I assure you, I swear, I'm telling you, that the moment we see a nice valuation, all of a sudden risk seems appropriately priced. You're putting a decent price on the risk. We're willing to roll the dice. Like, okay, there's a lot of risk here, but you know what? If it works out, it will have been worth it. So yeah, I think I'll write the check. Versus if the valuation is what we consider unreasonable, then it's like, okay, you might not make it. And even if you do, I'm only going to make 2-3 times my money at the end of the day. I can make that on the public market. That's not why I'm doing this. This is a fun hobby, but it's a lot of work, and it's work that stays with me for years. I got to stay with it. And by the way, you're going to need help raising your second and third, in some cases fourth round. I'm going to be there to write the next check. And execution is not a given. There's going to be all types of hiccups and bumps and scrapes, and it's a messy, sloppy game getting to the exit. So make me feel it's worth it early on. Write the check, and don't fight over valuation. I think Stu said, and it's a paraphrase, but take the money, take the money, take the money.
Nice. Let me stick on you for a second, Reese. So take the money, write the check. Also popular question, convertible note, safe. I'm not even sure founders understand the difference. What's the difference for you as an investor? What do you prefer?
Well, we like a priced equity round. So convertible preferred. We look at the National Association of Venture Capital, NAVC. They have a great document repository that's free. It's on their website. The NVCA, sorry, National Venture Capital Association. It's hard to get through it. It's cumbersome. It's a site only a lawyer could love. David, I recommend it for nighttime reading. And it's something you shouldn't try to master on your own. If you're an entrepreneur, again, rely on the use of a really great corporate attorney for that. But so we like that because it allows us to price risk, and it has a lot of bells and whistles that if let's say we can't agree on valuation on the state of valuation, we can make it up in other ways, preferences and stuff like that. And so there's some great resources out there. You can take the time and kind of educate yourself on what that's like, or kind of what that looks like. Many times a company might be a little too early to establish a meaningful valuation, or it's just that, we know there's going to be a much bigger investor down the road that this company's going to need as part of their cap plan. And we're angels, and we like to consider ourselves micro VCs, and we think we're pretty darn smart, but we recognize that we're kind of like second at least on the food chain. And so we're going to let the institutional investors, the VC or the corporate VC, set the valuation. So let's just do a convertible note, which means we're going to kick the can down the road on the question of valuation. But while we wait, we get a decent coupon, a little interest while we're waiting. And that interest might be in stock. We prefer stock, but it could be in cash, deferred until exit or conversion or something like that. But and then there'll be a cap on that to say, it would be a sin if we were doing say, okay, we're not going to establish a valuation right now, but then all of a sudden you go from like 1 million pre-money up to 100 million by the time the VC comes in. Like, wait a second, we took all that risk you back when you're only worth $1 million, and now our stakes going to be valued 100 million. That's not fair. So we put a cap on it, that's negotiated. And then there's the discount into the next round. There's some great resources online, but don't trust yourself. Educate yourself online, but then do work with a great attorney. But we're fine with convertible notes. We prefer equity round. But equity, again, it takes a long time. It's more expensive. You might spend anywhere from 15 to 30,000, depending on the deal, to get an equity round done versus a convertible note you can get done for a lot less expensive, a lot less money. Quick note: we don't like safes, and I saw in the chat there about safes. The good news is safes have over time become convertible notes, and that's fine. But safes in and of themselves, traditionally, they did not have caps on valuation. They did not have coupons, and they didn't even tell you whether they're equity or debt. So you didn't know where to put it on your balance sheet. You didn't really know what you got. And that's because they came out of Y Combinator. Y Combinator was what economists call a monopsony, which means the buyer's union. The buyers had the control. Y Combinator was turning out so many awesome deals that they had all the market control. And so they said, you know what? We're going to let you maybe have a piece of something. We don't know if it's equity or debt, but when we're ready, we'll tell you what it is. But if you want to stand in line and not get, if you want to be inside the building and not outside the building, just give us the money now. We'll give you this safe. Well, that was for a different time and a different place. Most of you are not in Y Combinator, and investors have gotten a little smarter. And so safes are nice because they're elegant, sweet, and simple, but intelligent investors won't stand for them unless they look like convertible notes with a cap, with a coupon, and with some type of discount. We find that you will perjure yourself and prejudice yourself in many regional markets, like in the Southeast, if you say we're offering a safe. Just call it a convertible note. And if it is a safe, then so be it. You maybe outsmart us, but we'll probably figure that out. So anyway, I'll pause there.
That's good nuggets there. Kicking the can down to Sean, the VC. What's your take on the convertible note safe, and is there a preference by SOSV?
Yeah, so I'll start off with an appropriately ageist reference. Back when I was raising money, it was all about priced rounds. I mean, I remember the first round I ever did back in 1996, I want to say. It was $500,000 at a 2 million priced round. It didn't cost a fortune. It wasn't a big deal. And as an investor today, I never see priced rounds. It's an annoyance, except in later rounds. I invested pre-seed and seed primarily, so it's always a CLN or a safe almost exclusively, and that's because of the cost, as Reese pointed out. And it's frustrating. There are organizations out there that will do like sub X round, law firms that'll do a sub X round at a fixed price because they really aren't that complicated. It just is more work. It is actually more work. And the world has changed financially since 1995. It's been 30 years now. And there are different rules and requirements that are in place that increase costs. So I get it. We at SOSV, we do a ton of CLNs. CLNs are definitely preferred for all of the reasons that Reese stated over safes, but we do plenty of safes too. Safes are just so quick and easy. At D-Lab, we do a ton of safes, and it's actually the norm in crypto world is a safe and a token warrant. So it's very, very common, but they are not the open-ended safes of yore. They have caps. They often have a rate of return in them, whatever you want to call it. But the thing is that from an investor perspective, there are rules about when we can mark companies up, and that's important to us to be able to mark companies up. So when you do that next round and you do get your 2x, from your post money on your last round, we want to be able to put it on paper and go back to our investors and say, look, I'm making you money. I mean, it's not money yet, but look, it's cool. It's on paper. And we can't do that really with CLNs and safes. Some people do it. It's not entirely kosher. But we love priced rounds. And so when you show up at a seed round and you doing a priced round, like everybody goes, oh, cool. This is interesting. Your pre-seed investors must love you. Or, same thing with an A. I see people raise their A rounds on friggin' CLNs, and these investors that allow them to get away with that make me want to scream. And I think it's a little irresponsible because we are setting a value, and it's not just for us as an investor; it's for you. You want to know what you have. To Stu's point before, the delta between this valuation and that valuation might not be that big to you when push comes to shove, but it's kind of like helpful to know what you have. And one of the problems that you see when people stack their notes and they stack their safes is that all these friggin' discounts start to add up. And a lot of times somebody will come to me, one of my portfolio companies will come to me after 4 years of raising stacked notes and stacked safes. And they'll be like, hey, can you help me understand how the cap table is going to work? And you work all these discounts in, and they're like, holy crap, I don't own anything. I'm like, well, you were selling this shit. Weren't you doing the math? And so there's a lot of risk that the founders create for themselves through a willful ignorance, if you will, of not doing the math on these things. When you price around, bam, you know exactly what you're going to get. The other thing that I'll add to this reason not to do all these stacked safes and stacked notes and reasons to price is that um, uh, as an investor, when I come in and see a bunch of stuff before me, and then you want me to come in on a convertible, I know that there's at some point you're going to need to raise a real round. And that investor might actually screw all of us. They might come in and say, hey, I don't know what this mess is. And if we convert it the way it says we're going to convert it, these founders won't have anything. And so it's sort of this like mini cram down where they'll say, actually, you're all going to convert to common. Fuck you. We're going to take this company now. We're professionals, and so, as an investor, I don't want to get into that mess and contribute to that shit show. So, people have gotten very fast and loose about it, and I think it's suboptimal. But hey, I'm feeding it too. I'm guilty. Guilty as charged. But be smarter than me.
Yeah, I love that. Do the math. That's all it takes. Just do the math. Stu, I won't. I mean, if you want to, I know, I know the whole topic of financial stuff may not be what you want to talk about, but if you have any last thoughts on this, please let me know.
I do actually.
Okay.
I wrote a piece years ago about how convertible notes are used inappropriately and too commonly. Um, the idea that you're kicking the can down the road on valuation with a convertible note is actually a misnomer, in my opinion. Um, and I caution everybody who's listening to think about what Sean said a few minutes ago about, when you think when a founder or a CEO, it's often just driven by market dynamics, gets a valuation that's an outsized valuation to the upside. They think that they've pulled off some kind of a victory. It's not the case. Unless it's going to be the last time you raise money, you're setting yourself up for some big potential problems because, like Sean said, if you have to do a down round, that hurts the founders, not the investors. And it can come back to bite you in a big way, getting a valuation that is inordinately high. It also creates an optics problem for the next round. Like it may prevent you from even raising money, but when I started doing this stuff, convertible notes, I think one of the guys, we're all three on your panel have a couple of gray hairs. One of the guys said something about, if there wasn't a cap, there was a time where you often had convertible notes with no cap, and it was like kind of a crazy security, like, yeah, you're giving people money with which to create value that they're going to use against you when they convert you into the next round. So it kind of became the standard move that on a convertible note, and to me, safes are, similar instrument, just with a little less protection. But you put a cap on it, and that's the standard. So how are you avoiding a valuation discussion, right? The cap is the perceived valuation, and that cap is going to create problems for you too, or can create all the same problems as having priced around too high. Often investors will be a little bit more loose with what they'll allow on the cap than they would have on a priced round. And then you go out to raise the next round, you're not exceeding the cap. And every single investor begins the conversation with, so what went wrong? So I just don't get it. Like, you know, I launched a company once that was concept stage, and Sean was saying how he raised $500,000 on a $2 million pre-money in 1996. I did that in 2012, and my lead investor, who had lost a couple of $1 million in my prior company, was my lead investor in my second one. And he said to me, I just think the valuation, should be a little lower. I think we had suggested 3 million, and he said he thinks it should be 2 million. And I was like, okay, I don't really know or care. Can we just split the difference? He was like, sure. That was the negotiation. But I just want to reiterate a couple of quick things, which are, again, the valuation isn't really critical. And, fighting over those nickels in valuation is not a good idea. I don't think convertible notes to me are what you use when you're doing an inside round, which is a bridge to a future event certain, such as an exit, a biz dev deal, or the next financing. Why people use them in early stage companies, they think, well, we don't have to decide on valuation, we'll figure it out later. And it's not true if you're applying a cap. So at the end of the day, valuation is the negotiation. I just want to say two really important things that I've been wanting to say for an hour. You shouldn't be speaking first in a negotiation, and you shouldn't even be suggesting a valuation. The valuation is the negotiation. When you go to meet it, you should be listening, guys. If you run a company, a startup, when you go to meet investors, tell them about your business, tell them how much money you need to achieve your goals. What Reese was talking about, milestones and budget, right? So here's the use of funds. This will enable us to, generate these milestones, which will create value for all of us. So now make me a proposal. I need $1 million. Tell me how much of the company you want to buy for that million, and ask them to speak first, and try to get a couple of people to compete against each other. But the use of convertible notes to try to avoid that problem, it isn't really happening. So anyway, I'll stop there. But yeah, period.
Awesome. Thanks, Stu. Good advice. Yes, Reese, please.
Two super quick points on convertible notes. I forgot. And that is from the investor's perspective, and you can take the inverse as the entrepreneur. On one hand, we like them because they're a debt instrument, which means, God forbid, your startup goes under. We stand in front of every single equity shareholder in bankruptcy. So if the asset's good, including the IP, we are going to get paid before any other shareholder. Your common, your preferred, et cetera. We are first. Now, the downside, the reason we don't like convertible notes as investors is that we may or may not be able to get on your board because we're not shareholders. We're debt holders. Right now, the understanding is eventually we'll convert and become shareholders. But I have been involved in deals where they're like, well, yeah, you technically can't vote on this or that because you're not a shareholder. Like, oh, okay. So sometimes that's resolved at the moment of conversion, but just something to think about. Anyway.
Yeah.
And safes are even weirder, like even weirder than CLNs when it comes.
I don't like safes.
Yeah, it's a convenience instrument. Remember where it came from. Remember why it exists. Remember how YC works. If you don't do the research, I think YC is a great organization. I don't agree with some of the ways they do things, and safes are one of the things they use for their own benefit. Not just for everybody, not just for the entrepreneurs.
Great, thank you for that. I think that this is you all said amazing things. Let's talk about just as we wrap up. Maybe Sean, we can start with you. What are some of the mistakes you see that kind of founders make that, I don't know, signals to you that this is just not working? Like, no, like it could be at any stage. It could be at pitch. It could be, a company that you've already invested in. What are some of the things that maybe you can forewarn people about on the call?
Yeah, that's a tough one. I mean, there's 100 reasons why companies fail. Although Reese pointed out that 99% of the time it's because you just run out of money. Um, that's usually the result of some other incorrect behavior. Um, the things that I would want to counsel people to think about are that timeline is really important. Like I say, people raise not enough money all the time, and oh, we only need 6 months of money, and I'm like, why? You're going to be profitable at the end of 6 months? No, no, no. That like will prove what we need to prove. Well, it takes 6 months to raise. If you're going to not be raising money and it takes 6 months to raise and you need to do 6 months of work, then you need a year of money. So you can do your work for 6 months and then you can go raise for 6 months while you're not working on the core product or market or whatever it is that you do. And so raising not enough money. And then you have people on the other side of it, like, we need $50 million. It's like, great. What have you built? Nothing. We need $50 million to build it, though. Like, well, that's not how it works. You need to some amount of time. You can't have 5 years of time up front, or maybe you can, like in the pharma business, where you're going to raise $50 million at a 10 million pre and give away the vast majority of your company in order, because you really do need that kind of capital in some cases. But most of the time, you need to figure out what that stepping function is. And somebody said it before, Stu or Reese, that it's 18 to 24 months. That's the rule of thumb. Um, if you're raising 4 years of capital, I'm like, that's a lot. Like, why do I, as an investor, want to put my money to risk for 4 years to see something happen, as opposed to putting it at risk for 12 months or 18 months or 24 months? And 12 is a little short, but sometimes it makes sense. Remember that as an investor, it is about multiples at the end of the day. Like at the end of the day, the most successful investments are measured in the return, and you've heard it repeatedly: 5x, 10x, 30x, 100x. That's what people talk about. But we also get measured on IRR, which is the rate of return, and that for that time's a factor. And so if I risk my money for 18 months with you, I want to know what I'm buying for those 18 months, and that at the end of that, there's a 2 or 3x step up on your post money from that money around I invested in, so that I can say to my investors, look, I'm being responsible with your funds, to Stu's point. Um, and so, like that timing thing, it's really hard for a lot of entrepreneurs because, especially the first timers, if you haven't done this, and doing it once doesn't make you a genius by any means. I made mistakes on my sixth company. And I make mistakes today. I mean, I've done 150 or so early stage startup investments and in my career, and I still screw up with some of my portfolio. Thankfully, there's always smarter people around me to help. But it's so hard to get that cadence sorted out. And you don't throw around 18 to 24 months as some generic number because we said it's a rule of thumb. What the hell am I buying? What are you going to accomplish? Why will it double your valuation? And why will it allow you to make this pitch to other investors to give you more money at a higher valuation later? So I'll just keep my response to that, which is this timing thing. And it's very hard to project. Like nobody knows what's going to happen in 6 months. I always tell my CEOs, I want to see your financial model. I want to see your predictions. And the smarter people will tell me, I don't really believe these. And it's like, you know what? We don't either. We know that at these early stages, that stuff doesn't mean anything. What matters is how you think about it, how you model it, how you look at the problem. The numbers are garbage. They're overly optimistic. You think things are going to sell too fast. You'll be able to sell stuff fast. It always takes longer. It always costs more money. That's okay. We're used to it. We're inured to that fact. And but we need to know that you're thinking about this stuff in an intelligent fashion, and it's very, very hard to project even a year and a half out or 2 years out.
Awesome. Well said. Well said. Stu, thoughts on this?
Yeah, I can, there's a million mistakes that folks make, and there's many that are common, but I'll give you just one that does kind of drive me nuts, and I think it's actionable advice for people. It's easily avoided. Sean kind of stuck to one thing, talking about, timeline and milestones. My thing is, every day I get pitched. by somebody, right? And I begin so many of these, video calls or meetings, and I say, tell me about your business. And I get a 20-minute speech about their product. And then at the end, I say, okay, well, I don't know how to invest in that because you didn't tell me anything about what Reese referred to as the capitalization plan. Like one of these guys just said, oh, it was Reese said 85% of your time you're spent raising money. The CEO of a startup, your job is raise capital, right? So if you didn't even mention how you're going to get to the next round, how you're going to raise that money, what the plan is, how much money is going to be needed, how do I invest in this? It's not a business. It's just a lemonade stand, right? Or your distribution, your go-to-market strategy. Like there are a lot of things involved in building a successful business that go beyond just how cool and unique your product or service is and how much better it works or tastes than everybody else's according to your friends. So, make sure that in your deck, which by the way, I guess I'm going to say two mistakes. Your deck, the key fundraising, material item for raising money. If you're an early stage company, trust me when I say this, and you're going to watch Sean, David, and Reese all nod their heads. Less is more, right? Ernest Hemingway said, I would have written you a shorter letter, but I didn't have the time. We're not going to read a 40-page deck, and neither would you, right? When you get a 60-slide presentation, you probably delete it. Or if you think the topic is really interesting, you go, oh, this is so interesting. I'll save this and I'll look at it later. Those are the emails you find in your inbox 9 months later that you never got to, right? So for a real early stage pre-revenue startup, your deck should be a dozen slides. I can live with 18, but if it's 30 or 40, I'll probably delete it. But anyway, just back to the other thing real quick is when somebody asks you to tell them about your business, tell them about your business, not just about your product or service.
Excellent. Thank you, Reese.
I just want to say this has been so enjoyable because I've actually learned a ton from Stu and Sean as well. So this has been great. Anyway, yeah. So one thing, I'll be super quick. Entrepreneurs kind of arrogate themselves that they understand the competition, but I find very few entrepreneurs are very serious or honest about what their competitive positioning is. They don't. They either pick vanity aspects or metrics where they, like we stand out in this realm. Does it really matter, or does it matter enough? Because a lot of times we've got the best, whatever gizmo on our wackadoodle, like, and think about, yeah, okay, so that might result in 3% more sales, and I know that's important to you, but we're not seeing it, and we see thousands of deals a year. So being very brutally honest about your competitive positioning of your product, and more importantly, to Stu's point, your company, and understanding that the whole concept of not just direct competitors but substitutes, and just right now being honest about what are your prospective customers doing now, how are they dealing with their problem presently. Very, I think Sean had mentioned that, like, we're really looking at your thought process. How do you intelligently assess the market, not only your technology and your business, but your competitive landscape? And part of that is being just really articulate in how you look at the competitive landscaping and your positioning in it. The more honest you are, we're like, yeah, you know what? That entrepreneur might be not in the best competitive positioning, but we like the valuation, we like the product, we think it's a hot space, and we like to bet that on this team because we like their perspective, and we like their honesty and integrity. You rarely hurt yourself by being brutally honest with the investors and with yourself. A lot of times you can win over a deal just by, and that brings up my second point. And this is more to entrepreneurs at post close. Communication and integrity are so key. Investment is a marriage. If you don't like marriage, if you don't like having somebody move in your company with you, then don't take outside capital, for God's sake. Just self-fund, bootstrap, whatever. But it's a marriage, and we're going to be there. Our interests are largely aligned once we write the check, and so we want you to succeed almost as much as you do. And but we can't be on that journey with you hand in glove unless you're honest. I just one really fun anecdote. I don't call it fun. pejoratively. We bet on a life sciences company, amazing management team, awesome space, orphan drug designation, really just so many things to love about this company. We got a good valuation. And then, my God, like a month before they run out of capital, like, oh, we're running out of capital. Like, what? Really? What, buddy, this is us. We're doing this together. We can help you organize the next round if you'd like. I mean, believe me, we're on the same side here. But why are you? What were you in denial? Were you trying to? We just it spoke to a lack of so many things, and so we're in it together. So constant communication and integrity and honesty is so important, really important. I find that in short supply increasingly. I don't know if it's a comment on American business culture or what, but it's so just take that to heart. It's really rewarding. I think that sometimes the good guys do finish first, and if you're honest and great communicator, I think you'll come out ahead in this space, because this is the hardest thing, other than joining a rock group. This is the second hardest thing you can attempt to do: bring a new product or service to market. Do I have 60 more seconds? You want me to put that?
Go for it, please.
Okay, all right. So negotiations, when you're actually trying to raise capital, it's a chess game on 3 levels, right? There's the substance, right? That's the nuts and bolts of the term sheet and the economics and the bells and whistles, right? Okay, fine. Lawyer up, do your homework, etc. There's the personal, okay? We know if you despise us as investors. We know if you don't enjoy raising capital. Don't telegraph it or get over it. If you hate raising money, then bootstrap, do something else. But the point is, it isn't marriage. It's a personal thing. Realize that we're assessing all that: your confidence, your comfort, and are you a good partner? So there's the personal aspect of that second tier of the chess game. The third tier is the process, the procedure. I can't tell you how many times entrepreneurs will pitch us and we think there's a decent deal there. We think we're within the valuation range and the terms. We'll have to negotiate and beat each other up a little bit. We like the team. We like everything about it. And then we say, okay, come back with this, or we need to know more about this, or can you help us provide this projection or this document or this introduction? And then it's just like 4 weeks go by, 5 weeks go by, 6 weeks, that something isn't connecting here. The process, I mean, like, we strike while the iron's hot. And that third thing, the process, is a key part of that 3-dimensional chess game. The personal relationship key, the substance, of course, but that process, you got to manage the process. And if you're not, I understand you only have 5% of your time to run your business and fires happen and all that. You got to address that. I get it. But make sure you have, like, as best you can, prepare your business and your family and your personal life for that raise. Because when the opportunity comes, it comes, and you've got to stand in the door and you got to deliver. And timeliness is important. If you can't kind of come back with a document within a reasonable period of time, we interpreted that a couple ways: that you don't know, you're not capable, you haven't assembled a team to get to the answer in a relevant time frame, you don't think we're important, or you don't like you. Maybe you're talking with other investors and you got a bigger deal down the line. So really important.
Awesome, thank you. So we're pretty much over time. I'll let one person ask a question. The first person to raise their hand on their. Okay, I guess Pranita, you're it.
Okay. My question is to the investors is that recently my digestive gummies have formed, and soon it's going to be out into the market. What are the steps I need to take for the venture capitalist to help me to scale my business? What mistakes I can avoid, and how best way I can please the investor that they put implicit faith in me and into my company that's already been it's going to be starting soon. So could you give me some advice into it?
Stu, this is like right up your alley, I think, right? This is a food supplement.
Yes.
It is and it isn't. It's a little earlier than what
it's early. That's what I was going to say.
Look, what I always say to folks is, as Reese was saying before about your capitalization plan, I always say to folks, you got to capitalize a company the same way you do everything else in building a business, in stages, right? So don't look at Mount Everest and say, I got to get to the top. you look at it and you say, I got to get to base camp, right? Base camp A. I got to set up there, get acclimated, and then I'll figure out how to get to base camp B. So base camp A for you is friends and family money, and so not everybody
No, no, no,
has.
no. I'm being funded by the organizations here. I mean, my company is based in Canada, and it's through the women's organization. Uh, uh, 80 to 90% it's being funded by them. The rest of the money I put the money in. So I'm just, yes, I will be putting some money into it, and I have a business plan and I have a financial projections. But now I'm in a position that what exactly I need to be doing to scale my business out of my country. Because right now I have a good team who's supporting me, and it's making me progress every single day. But to scale my business internationally, I want the venture capitalist to put the money into my company, and they can just have implicit faith in my company and help me to scale my company internationally also.
Right. Well, I was trying to tell you, no one's going to have implicit faith in you other than your family.
Okay.
So I think you did. I think you did the right thing and the bold thing, which is the same thing I did, and I'm sure the same thing lots of people on this call have done or are doing, which is you bootstrapped and you put skin in the game and you prove this is not just a flyer. Like you're really putting yourself on the line, and investors love that. Canada we're investors in Canadian companies. The Canadian government is very supportive of the startup ecosystem. That's a great place to get non-dilutive capital. You're creating a CPG product and brand. You will not raise venture capital yet. It's not going to happen. So you have to scale this business, and base camp A is bootstrapping and maybe a little Canadian government money. Base camp B is raising friends and family money. And that's what I was trying to tell you, is that I think typically for consumer brands, the first outside capital comes from, kind of an angel raise, folks like Reese's group. And what my biggest piece of advice when it comes to raising angel money is, when you've exhausted what you can put in from your own bank account, and when you're too small to yet attract professional institutional investors like venture capital firms, the way to market an angel raise is to the friends of your friends. And because in angel raises, and I've conducted many, I find that relationship matters just as much as the product or the pitch. And so there's only so many friends or associates in your network who can write a $50,000, $100,000 check, $250,000 check. So you hit those people and you ask them if they're interested, but then also go to the people in your network and say, are there one or two folks who might be interested in this? Because it makes a huge difference when that mutual person, the connection, says to the investor, I went to college with Punita, or I used to work with Punita. She's a dynamo. She's brilliant. She works really hard. That endorsement is 80% of what that angel investor is going to make the decision on. And then I have one enormously important piece of advice for you when building a consumer brand. If you want to eventually get there to where you can attract, venture capital investment, just remember that revenue growth is secondary. Distribution growth, which most, early stage consumer CEOs get obsessed about, is secondary. What matters is unit velocity. It's not how many stores you're in or how much revenue you're generating. It's how many units per SKU per store per week you're selling. Because if you come to me and you're doing, $2 million in revenue, but it's only in 300 stores, I'll get you a blank check. If you're in 20,000 stores and you're generating 9 million in revenue, 9 million may sound nice, but that's a zombie company that's going out of business and just doesn't know it yet. So I urge you to remember these words. I've been doing this for 20 years. Unit velocity is everything to consumer investors. You're not there yet. Right now, you got to go scratch and claw to raise that first $500,000, and it's going to be from people you know or the people they know.
Thanks. Thank you.
Thank you.
Excellent advice. I appreciate it.
Agreed. Thank you, Pranita. So we are totally over time. Final thoughts, Sean, before we say goodbye?
No, this is hard stuff. When you guys were doing your intros during the networking time, I was off camera, but I had my audio on, so I was doing email, but I was listening as well. And there's a broad spectrum of types of companies here, from what I heard. Some of them are definitely not venture scale businesses. Some of them could be venture scale businesses, and you need to make those distinctions. You need to do that research. Definitely, to Stu's last point, reach out to your local networks, friends, families, and in Canada, there's a ton of wonderful resources available to learn this stuff. You don't just like pick up a book and learn how to raise money. Maybe there's a blog for it. I don't know, but certainly that's not how I learned it. You do it by screwing it up, and you need to learn all this stuff. And the amount of information we can transfer to you in an hour is nothing compared to what you need to know in order to get into the venture scale business. So do your research, talk to everybody, network like a mad person, and do that learning.
Amazing. Thank you, Sean. Reese, final thoughts?
Just a fun anecdote to embellish the last point. This was in the dust heap ashes of the .com era. I was serving on a panel with an entrepreneur who recently had accomplished a pretty impressive exit. And I was just like, how the hell did you pull that off? And he's like, oh my God. Ultimately, we tried everything. Ultimately, we backed into a shell of a public company on the Australian exchange and nailed it. I'm like, did not see that coming. But I wouldn't recommend that to everybody. I think you definitely need to try the main route. But the point is, there's always a way. And if you try plan A, B, and C, don't be shy to try plan D. But after adequate time for each, there's always a way. There's just so much capital out there for the right ideas and the right team. Don't give up, and be very resourceful.
Awesome. Stu, final words?
Yeah, when we meet founders, when we're evaluating them to whether we want to take them on as a client on the banking side, or if we're looking at their company for a potential investment on the principal investing side, humility matters. Somebody was talking about, transparency and communication. I think it was Reese. That matters in the pitch too, right? Like when I represent clients who do the typical entrepreneur thing and they're hyperbolic and they talk about how they're going to do $1 billion in revenues in year 5, I coach them off a ledge or I quit, right? And the best clients I've had and the ones who've been most successful in raising money, they're very honest with investors. And look at Reese and Sean, right? And think about, do you think you're really gonna get one by them? Like you're not, they've been doing this stuff a long time. They've heard it all. They can smell when it's being sincere or not. And we don't expect your company to be perfect, like we understand that you have challenges and problems because every startup does. If you try to pretend that you don't, what you're actually accomplishing is convincing us that you're not truthful or you're just someone that we're probably not going to want to work with. And I find humility and honesty in the pitch, telling prospective investors, here's the things that we're really excited about. Here's a couple of things we're struggling with, like that actually helps sell me knowing what the problems are. And I just urge you to remember, um, just remember, don't judge a man or a woman, until you walk a mile in their shoes, right? And if you do, and you then decide, yeah, the guy really was an asshole, well, at least you're a mile away and you have the guy's shoes, right? So there you go.
Wow, thanks. Stu, Sean, Reese. The only thing I kept thinking about was like just nuggets, gold nuggets from all of you. Thank you, thank you, thank you so much for doing this and for sharing your knowledge. Um, this will be recorded. This will be sent out to everybody next week with some recaps.
Oh no.
Yeah, we will have another ESS August 22nd. Look out for that as well. Thank you, everybody. Enjoy the rest of the day. Thanks to my speakers, and we'll talk soon. Take care, everybody.
Thanks so much, guys.
Take care. Bye bye.